The IRS just dropped a bombshell, and if you own rental property, collect Social Security, or you're counting on your retirement savings to last the rest of your life, you need to stop what you're doing and listen very carefully. Because what I'm about to share with you could change everything about how you file your taxes this year, how much you owe, how much you keep, and whether the government suddenly decides you owe penalties you never saw coming. This isn't speculation. This isn't rumour. This is confirmed. And landlords across the country, especially seniors and retirees who depend on rental income to supplement Social Security, are about to face a tax landscape that looks nothing like it did before. If you think this doesn't affect you because you only have one small rental or you inherited a property, think again, because the new rules cast a wide net and the IRS is not playing around with enforcement this time. Imagine you're 72 years old, you're collecting Social Security, you have a modest rental property that brings in $1,800 a month, and you've been doing your taxes the same way for 15 years without a problem. Suddenly, you get a letter from the IRS saying you underreported your income, you missed a new deduction rule, and now you owe not just the back taxes but interest and penalties that could wipe out 6 months of your rental income in one shot. That is not a hypothetical scare tactic. That is happening to real people right now. And the reason is that the IRS has finalised and begun enforcing major changes to how rental income is reported, how expenses are deducted, and how passive income interacts with your overall tax bracket, including the thresholds that determine whether your Social Security benefits become taxable. Yes, you heard that right. Your rental income can now push your Social Security into taxable territory faster than before, and many retirees are finding out the hard way that what used to be a comfortable tax situation has suddenly become a financial nightmare. If you're finding this information valuable, if you're starting to realise how much is at stake here, please take a moment to like this video and subscribe to the channel. Because the government doesn't send you a personal invitation when they change the rules, they just change them. And our job is to make sure you hear about it first before it costs you money. We break down these updates every single week, so you never get caught off guard, and every like and subscription helps us reach more seniors who need this information desperately. So hit that button now, and let's keep going because we're just getting to the part that really matters. The IRS has updated its guidance on Section 469 passive activity loss rules, which sounds like boring tax jargon until you realise it determines whether you can deduct rental losses against your other income, like wages, pensions, or investment returns. For years, many retirees qualified for the Special Real Estate Professional Exception, or the active participation rules that allowed them to deduct up to $25,000 in rental losses. But the IRS has tightened the definition of active participation, increased the documentation requirements, and made it much harder to claim that deduction if you don't have detailed records proving you made management decisions, approved tenants, or handled maintenance approvals. If you're the kind of landlord who just collects a check and lets a property manager handle everything, you could be in serious trouble, because the IRS now considers that passive activity and passive losses cannot offset your ordinary income the way they used to. That means your taxable income goes up, your tax bill goes up, and if that extra income crosses certain thresholds, suddenly up to 85% of your Social Security benefits could become taxable. A double hit that retirees absolutely cannot afford. The IRS has also clarified and expanded reporting requirements for short-term rentals. So if you've ever rented your property on a platform like Airbnb or VRBO, even for just a few weeks a year, you now face a completely different set of rules. The platforms are sending 1099-K forms to the IRS for anyone with gross payments over $600, down from the previous much higher threshold, and the IRS is matching those forms against your tax return with automated systems that leave almost no room for error or oversight. If you forgot to report that 2-week summer rental, if you deducted expenses that don't qualify under the new allocation rules, or if you failed to separate personal use days from rental use days with precise documentation, the IRS computer will flag it and you will get a notice. The penalties for underreporting have increased, and the IRS has specifically directed additional enforcement resources toward rental property owners, with a particular focus on seniors who may not be aware of the digital reporting ecosystem that now tracks every transaction automatically. Let's talk about depreciation, because this is where a lot of retirees get tripped up, and the IRS just changed how certain improvements are classified. For decades, landlords could depreciate the building value over 27.5 years, and the annual deduction helped offset rental income nicely. But the IRS has issued new guidance on what constitutes an improvement versus a repair, and the distinction is crucial because improvements must be capitalized and depreciated over many years, while repairs can be deducted in the current year. If you replaced the roof, installed new windows, or upgraded the HVAC system, the IRS may now classify those as improvements, meaning you cannot take the full deduction this year. You have to spread it out, and that could leave you with more taxable rental income than you expected. For retirees on fixed incomes, that unexpected tax bill can be devastating, especially if you already spent the money thinking you'd get it back at tax time. The new rules require more detailed cost segregation studies and documentation, and if you can't prove the exact nature and cost of each improvement with receipts, invoices, and contractor statements, the IRS can disallow your deductions entirely and hit you with accuracy-related penalties. When your rental income is reclassified, when your deductions are limited, when your Social Security becomes taxable, your adjusted gross income goes up, and that triggers a cascade of other financial consequences. You might suddenly find yourself paying higher Medicare premiums because those are based on your income from 2 years prior. And many retirees don't realize that a one-time spike in rental income can lead to permanently higher Medicare, Part B and Part D premiums for a full year or more. You might lose eligibility for certain senior property tax exemptions or low-income assistance programs. Your required minimum distributions from your IRA or 401k could push you into an even higher bracket when combined with this newly inflated rental income. And if you have a bank account that pays interest, that interest is now taxable at your higher bracket too, because every dollar of income stacks on top of the last. The IRS changes don't exist in a vacuum. They ripple through your entire financial life, and seniors who aren't prepared are the ones who suffer the most. First, if you are a landlord who has not been filing Form 1040 Schedule E correctly, or if you have unreported rental income from prior years, the IRS is offering a limited window to come forward through updated voluntary disclosure procedures. But that window is closing, and the penalties for waiting until they find you are exponentially worse than if you come forward voluntarily. Second, estimated tax payments for the current year are now more critical than ever. Because if your rental income has increased due to lost deductions, or if your withholding from Social Security or pensions isn't enough to cover the new tax liability, you must make quarterly estimated payments by April 15th, June 17th, September 16th, and January 15th of next year. Miss those deadlines and you will owe an underpayment penalty, even if you end up owing nothing when you file your return, simply because you didn't pay evenly throughout the year. Third, if you are planning to sell a rental property, the IRS has updated the rules on 1031 like-kind exchanges and the depreciation recapture tax rate, and the timing of your sale could cost you tens of thousands of dollars in unexpected taxes if you don't structure it correctly before year end. Margaret is a 74-year-old widow in Ohio. She owns a duplex that generates $24,000 a year in rental income. She has always deducted her property manager's fees, maintenance, insurance, and depreciation, and she usually shows a small paper loss that keeps her taxes low. This year, the IRS disallowed her active participation deduction because she couldn't produce documentation showing she approved the last tenant or selected the paint colours for a recent repair, both of which are now considered evidence of active participation under the tightened rules. Her $25,000 loss deduction vanished. Her taxable rental income jumped from $0 to $24,000. That pushed her combined income over the Social Security taxability threshold, making $14,000 of her benefits taxable when they weren't before. Her total tax bill increased by over $6,000. She had to pay a $500 underpayment penalty because she didn't make estimated payments, and her Medicare premiums will increase next year by over $2,000 due to the income spike. One IRS rule change, one missing piece of paper, and Margaret is out nearly $9,000. This is not fiction. This is the new reality, and it could happen to you. First, gather every document related to your rental property, every lease, every receipt, every email with your tenant or property manager, and organize them by year. If you cannot prove you actively participated in management decisions, start documenting everything immediately, because the IRS is asking for this evidence during audits now more than ever. Second, review your prior 3 years of tax returns with a qualified tax professional who understands senior tax issues and rental property rules, because if you made mistakes, you may still be able to amend those returns and get refunds, or at least correct the record before the IRS finds it. Third, recalculate your estimated tax liability for this year using the new rules. And if you owe, make a payment as soon as possible to stop penalties from accruing. Fourth, if you are considering selling any rental property, talk to a tax advisor before you list it, because the new depreciation recapture and 1031 exchange rules could make the difference between a manageable tax bill and a financial catastrophe. Fifth, and this is critical, review how your rental income affects your Social Security taxability and your Medicare premiums, because what looks like a good year for rental income could actually cost you more in hidden taxes and premium increases than you earned. You worked your entire life to build security for your retirement, to have a little extra income from a rental property, to leave something for your children, and to live with dignity and peace of mind. The government is not going to protect that for you. The IRS is not going to send you a friendly reminder, and the tax code is not going to get simpler. The only way you keep what you've earned is by staying informed, staying proactive, and taking action before the rules change underneath you. The seniors who get hurt are not the ones who break the law on purpose. They are the ones who didn't know the law changed, who trusted that doing things the old way was still good enough, who thought a small rental property couldn't possibly attract the attention of the federal government. Those days are over, and the only defense you have is knowledge. Share this video with every retiree and senior landlord you know, because too many people are going to be blindsided by these changes, and we have a chance to get ahead of it together. Leave a comment below telling me if you own rental property and whether you've noticed your taxes getting more complicated lately, because I read every comment and I want to know what you're facing out there. And if you haven't already, please subscribe and turn on notifications, because we are tracking these IRS updates in real time, and the next change could be the one that saves you from a massive tax bill or a devastating penalty. Your financial future is worth fighting for, your retirement is worth protecting, and you are absolutely capable of navigating this if you have the right information. Stay informed,